attractive price given the quality of the bank. This came to $17.7 million. Buffett used Berkshire's now strengthened balance sheet to fund the purchase of the bank. Marketable securities were almost completely sold, raising approximately $11 million. The shrinking textile operations provided almost $4.6 million through reductions in working capital and physical plant investment. Berkshire also augmented its funds by borrowing an additional $4.75 million. Berkshire, under the leadership of Warren Buffett, was becoming a very different company. 1970. Berkshire's mix of businesses produced equally mixed results in 1970. Its newly acquired bank did very well, insurance was mixed, and textiles were, unsurprisingly, mediocre. Textiles. Still, the textile division's management team deserved compliments. Calling out Ken Chase by name, Buffett praised Chase and his group for their efforts to turn around the division while swimming against a strong tide. That tide was the confluence of factors making the economics of textiles in New England unsustainable: high relative labor and electricity costs, coupled with stiff overseas competition. In response to poor demand in both menswear linings and home fabrics, the division reduced production. This meant making sure inventories did not grow too far out of line from current sales levels. Over the preceding 5 years, inventories had averaged 25% of sales. With sales down 39% to $24.6 million in 1970, the ratio ballooned to 34%. Fluctuations in sales are not atypical in business, and if a manager expected to return to higher sales levels, inventories might be maintained at the same dollar levels as before. With textiles, though, a commodity whose finished products were subject to style trends, expensive to make, and where demand had dropped over time, waiting was not an option. Despite the large drop in sales, the division eked out a tiny $107,000 profit, a good result relative to the large drop in sales, and certainly better than a loss, but far from satisfactory in relation to the capital employed in the business, $11.1 million in average non-cash working capital and $2.8 million in average property, plant, and equipment. Insurance. The insurance segment turned in mixed, though generally satisfactory results in 1970. Buffett said growth was outstanding, with premiums written and earned up over 55% to $45 million and $39 million respectively. That included $7 million of written premiums in the reinsurance segment, over 2.5 times the volume done the year before, but he was quick to point out that growth in premiums was accompanied by a somewhat poor underwriting picture. This led to an underwriting loss of $330,000 for the insurance group, which meant that any earnings from the segment had to come from investing. It is clear Buffett's enthusiasm for insurance remained strong despite the higher loss ratio. This is because he understood how the business worked. The operating philosophy of National Indemnity was to catch waves of business when it became profitable. That year, a surge of volume resulted from more restricted markets, meaning other insurance companies pulling back after losing money. Ringwald's development of home state insurance operations in 1970 signaled the future operational mantra of Buffett and Berkshire. The first operation was Cornhusker Casualty Company in Nebraska, a 100% owned subsidiary of National Indemnity. It wrote premiums of $249,000 that year. Buffett noted its big company capability and small company accessibility, demonstrating the advantages of decentralized operations. Today, decentralization is the operating philosophy in all of Berkshire's operations. As the Berkshire Annual Reports would later remark, Berkshire's operations are managed via delegation just shy of abdication. If readers were not yet convinced of Buffett's enthusiasm for this operation and for Ringwald, Buffett let them know first that Ringwald brought the concept to life and that there were plans to form more companies under the home state banner. Banking. Turning to Berkshire's new banking operation, Buffett was all praise for Illinois National Bank. He noted that the bank's operating return was the sign of an exceptionally well-managed banking business. The bank earned a strong 1.9% return on average assets, ROA, in 1970. It's worth pausing to note that while a 1.9% return may appear very low on an absolute basis, even lower than that of basic savings account at the time, the economics of banking are such that it was truly an indication of a well-managed bank. Because banks have the advantage of using leverage, meaning they hold many more dollars in deposits than they do in equity capital, That 1.9% return on assets turned into a return on average equity, ROE, of 12.5%. The concept is similar to the return on capital calculations used elsewhere in this book, with leverage factored in. See the equations below. Using the figures from the Illinois National Bank, we can see how its ROA is an indication of good economics and translates into a satisfactory ROE. Because the bank had nearly 7 times the amount of assets as it did equity capital, the ROA is multiplied or leveraged by that same factor. While the use of leverage in the bank may seem, and is, high compared to other businesses, from a banking perspective, it is on the conservative side. Today's banks routinely use 10 or 12 times leverage. This creates higher returns on equity but brings additional risk and is one reason why banks are so tightly regulated. The results from Illinois National Bank were achieved while maintaining high levels of liquidity. Its average loans to deposit ratio was just 49%. For perspective, today's banks routinely loan up to 80% of deposits. The remainder of Illinois National Bank's assets were in the investment portfolio or sitting in cash, with a small portion in premises and equipment and other assets. In short, Illinois National Bank was a conservatively run bank that managed its costs exceptionally well and as a result was highly profitable. This was a testament to Eugene Abegg and his management team. Having just acquired Illinois National, Berkshire learned it would be required to sell it. At the end of 1970, Congress amended the Bank Holding Company Act of 1956 to include one-bank holding companies. The law prohibited these companies from owning non-bank companies. This meant Berkshire would not only need to sell the bank it had just purchased, but also be subject to oversight by the Federal Reserve Board and have restrictions on its acquisition activity. But Berkshire had some time. The law gave Berkshire 10 years to sell, spin off, or otherwise dispose of Illinois National. In the meantime, as we'll see, Berkshire enjoyed the fruits of its ownership of Illinois National and entered the banking business in other ways. 1971. In his opening paragraph to the 1971 annual report, Buffett included a reminder of his management objective. That objective was to improve return on total capitalization as well as the return on equity capital. Buffett noted that Berkshire's return on equity that year was 14%, which was above the average of corporate America. He highlighted his goal to improve return on total capitalization, the sum of long-term debt plus equity, as a reminder that Berkshire would not go about achieving high returns on equity by leveraging the balance sheet through excess borrowing. Although Berkshire would borrow funds at the parent level from time to time, and did so in 1971, these amounts would be very conservative. Notably, the satisfactory return on equity of 14% in 1971 included drag from inadequate earnings of the textile division. This highlights the success of the strategy to redeploy capital to greener pastures. Textiles. Notwithstanding considerable efforts to reduce costs, the textile division struggled with low gross margins. A mild industry pickup was thought to be on the horizon with more favorable volume and mix of business in the coming year. The inadequacy of the textile group's returns is evident in its financial performance during the year. The meager operating profit represented a pre-tax return on capital of just 1.9%. See Table 3.6. No wonder Buffett was so quick to move on. Insurance. Quite contrary to the industry headwinds experienced in textiles, the insurance division, whose financials were now reported together under Insurance Group, had a considerable tailwind in 1971. As a result of some significant good fortune, the industry experienced reduced auto accident frequency, higher premium rates, and an absence of major disasters. For Berkshire, this translated into 47% growth in premiums written to $66 million and a solid 95% combined ratio that brought in $1.4 million of underwriting profits. This was all good news if you took it at face value, but when viewed as the calm before the storm, it carried a warning. Buffett knew this and was quick to point it out. "We shared in these benefits, although they are not without their negative connotations," he wrote. These strong results would bring more competitors into the marketplace. Those competitors would drive premiums to the point of unprofitability. It was only when competitors faced losses that they would either raise rates, pull back on writing business, or both. Until then, Berkshire's insurance managers would focus on underwriting profitability, volume be as it may. Keeping the focus on the long term, Berkshire continued the expansion of its home state operations. During 1971, it formed Lakeland Fire and Casualty Company in Minnesota and Texas United Insurance in Texas, which legally formed in 1972. The home state business accounted for just $1.5 million in premium volume, but volume was expected to double in 1972 with these new additions. Another area of insurance growth in 1971 was the acquisition of Home and Automobile Insurance Company in Chicago on September 30th. With volume of $7.5 million a year, Buffett highlighted the similarities between its founder, Victor Rabb, and Berkshire's own star managers, Jack Ringwalt and Eugene Abegg. While National Indemnity accepted just about any risk from almost anyone, requiring price one-off policies, Rabb focused on insuring those within Chicago's urban areas, a more statistical type operation. Buffett saw so much potential in this new acquisition that he added capital to the business because Rabb was continually up against capital limits that hindered growth. Although we do not know the precise amount added to home and auto because it was consolidated with Berkshire's other insurance operations, an additional $8.5 million in equity was added to the insurance group to support its burgeoning premium volumes. This amount was partially funded by a new $9 million loan. A portion of the proceeds repaid the outstanding balance of a prior note. Commenting on this debt financing the latter part of the 1971 chairman's letter, Buffett stressed that Berkshire wouldn't overburden its balance sheet. Berkshire's insurance and banking subsidiaries possessed a special fiduciary relationship with the public, and this required Berkshire to always remain very strongly financed. This meant that, at both the parent and the subsidiary level, Berkshire would always unquestionably fulfill our responsibilities. From the consolidated balance sheet at year-end 1971, Berkshire owned a total of $9.6 million compared to equity of $56.2 million, a debt-to-total capital ratio of just 15%. Banking. Berkshire's banking division faced a tough year in 1971. Interest rates declined, which caused a corresponding decrease in interest income for the bank. Compounding the challenges on the income side was the nature of Illinois National Bank's deposit base. Its deposits were becoming more time-based as opposed to demand-based. Time-based funding, e.g. certificates of deposits, are much more expensive to a bank than demand deposits, checking accounts, which typically pay little or no interest. Nonetheless, Abegg and his team continued to hold the line on expenses and maintain the bank's conservative investment strategy of high-quality loans. 1972. Buffett described 1972 as a highly satisfactory year in large part due to the 19.8% return on beginning shareholders' equity. Each division contributed to the overall success, although the insurance group led the charge, partially due to the unusual convergence of favorable factors described in 1971. Before moving into a more detailed review of each division, Buffett took the time to comment on the past 8 years of his direct management of Berkshire. Since he took control in May 1965, operating earnings were substantially higher, and the diversification and redeployment of capital outside of the textile industry established a significantly higher base of normal earning power for shareholders. Shares outstanding had been reduced by 14% through repurchases, and book value, which was $19.46 per share at year-end 1964, had climbed 16.5% annually, ending 1972 at $69.72 per share. Lest Buffett be accused of claiming the credit for himself, he praised Jack Ringwalt, Eugene Abegg, and Victor Rabb, the individuals operating National Indemnity Company and National Fire and Marine Company, Illinois National Bank, and the Home and Auto Insurance Division, respectively. Textiles. It's worth pausing to examine some figures relating to the textile division for 1972. Inventories increased at a double-digit rate, but the increase in revenues was much more modest. Furthermore, a reduction in accounts receivable, coupled with increases in payables, freed up capital from the textile division. Capital requirements were controlled through careful inventory management and suggested a positive outlook for 1973. Another item deserving attention is the increase in payables. Because payables are monies owed to suppliers, the textile division was effectively borrowing from suppliers to finance its operations. This released capital from the division that could be reallocated by Buffett elsewhere. The practice could not go on forever as suppliers must eventually be paid, but it is common. For example, Walmart has taken this financial management strategy to an extreme, using its large purchasing power to extract long terms from suppliers. This means suppliers are financing Walmart's balance sheet as the price for doing business with the retail giant. In sum, combining the capital tied up in net working assets, fixed assets, and an estimate of the cash needed to operate the division, total capital employed in the textile division decreased by $1.5 million. This decrease in required capital, coupled with the improvement in operating performance, translated into a 16% return on capital, see Table 3.7, by far the best in many years and clearly a positive aberration. Insurance. Textile industry had a very good year, but it dimmed in comparison to the insurance industry. Although overall premium volume declined, profits swelled due to very favorable loss experience. This included National Indemnity's specialized business wrote premiums of $35 million, down 26%. Reinsurance wrote premiums of $11 million, down 24%. Home state operations had written premiums of $4.3 million, up more than 2.5 times. Home and auto delivered written premiums of $6.9 million. Those were substantially higher than the $2 million written the prior year for Berkshire, but down from $7.7 million written during the full year. Remember, Home and Auto was acquired on September 30th, 1971. Recall that a combined ratio of less than 100% is a good thing. The 1972 combined ratio was 93.7%. This meant that Berkshire's insurance group was being paid over 6% to do business with customers. This was on top of the money it made investing the float that came along with holding its customers' money until loss claims came in. Float at the end of 1972 amounted to $70 million. High interest rates meant Berkshire enjoyed an enormous economic advantage holding on to these funds. Additionally, Berkshire's bond portfolio had unusually good call protection, which would protect the high yields on those investments. The extremely good profitability enjoyed during 1972 almost immediately attracted competition. Resulting volume declines in 1972 brought expectations of lower pricing for the near future. Although premiums earned fell only 2%, premiums written fell 13%. Berkshire would continue writing insurance at the right price, but would let volume shrink if market rates were too low. Basing rates on long-term expectations and accepting lower volume short-term was the best path to above-average long-term results. If Berkshire was pulling back writing insurance business in the near term, it surely was not taking its foot off the gas in terms of building its capacity to write insurance. Berkshire planned to build on its acquisition of home and automobile insurance of Chicago with new operations in Dade County, Florida, and Los Angeles. Home State expanded with new ventures in Minnesota and Texas. All of these moves were made with an eye toward capturing more business when it materialized at appropriate prices. Banking. Like Berkshire's insurance group, Eugene Abegg and his team in Illinois National Bank were excellent underwriters of risk and rightfully deserved Buffett's annual praise. Charge-offs, or loans deemed uncollectible, were a mere 1/20th of those at other commercial banks. In 1972, the bank wrote off $4,669, no zeros omitted, or 0.0078% of its almost $60 million in loans, an exceptional banking record in any period. 1973. The chairman's letter in 1973 contained a flurry of information for shareholders. First, however, Buffett led off with his customary quantitative disclosure of Berkshire's return on beginning shareholders' equity. That year's results, a gain of 17.4%, was down from the prior year's 19.8%, but Buffett was quick to point out that it was the rate of increase in book value, not the dollar amount, that mattered. Indeed, earnings per share had increased from $11.43 to $12.18. Buffett reiterated, management's objective is to achieve a return on capital over the long term, which averages somewhat higher than that of American industry generally, while utilizing sound accounting and debt policies. From the vantage point of history, we know this objective was achieved by a wide margin. Textiles. The textile division reported strong results in 1973. High demand brought the trend line above average for Berkshire's textiles, but was just average when judged from an absolute sense. Partially holding back the textile group's performance were the Nixon administration's cost of living council's price controls. Buffett said these served to cut down some of the hills while still leaving us with the inevitable valleys. Textiles is a highly cyclical industry. Having a capped upside with unlimited downside was good for consumers, but terrible for a business owner. In response to inflationary pressures on raw materials, the textile group changed its accounting from FIFO to LIFO. LIFO, or last in, first out, is a method of accounting for inventory that matches most recent costs against current revenue. This was a change from FIFO, or first in, first out, which matches old cost against current revenue. If Berkshire had remained under FIFO, the rising price environment would leave it assigning low values to costs as it sold products, and thus incurring higher taxes. While other managements might have enjoyed the reported profitability boost that FIFO produced, since low cost equals higher profit and vice versa, Buffett preferred the more favorable economic result even if it depressed reported profits. Insurance. Insurance results were generally very good, although not without difficulties. National Indemnity and sister company National Fire and Marine had an exceptionally fine year, Buffett said, a fitting capstone for Jack Ringwalt, who retired as president after 33 years at the helm. He remained CEO. National Indemnity reported a $4.4 million underwriting profit on earned premiums of $30 million. That is impressive considering earned premiums fell 21% from the prior year. Buffett praised his successor, Phil Leach, as having the same qualities as Ringwalt. The reinsurance group experienced similarly satisfactory results during the year. Unfortunately, it experienced slightly lower volumes due to the influx of competition, chasing yesterday's good result. Underwriting profit came in at $353,000 on earned premiums of $12 million. Overall, the insurance group wrote 13% less in premium volume and earned 11% less than the year prior. Its profitability remained intact with the combined ratio increasing slightly, but still very satisfactory to 95.3%. This was good for $3.3 million of underwriting profits. National Indemnity's profits subsidized underwriting losses at Home and Auto and Home State. Additional challenges in the insurance group came from managerial issues. The Home State companies had good results in Nebraska and Minnesota, along with an expansion into Iowa, which combined with other successes provided optimism. But Texas was a problem that required a restart almost from scratch. Another area of weakness was in Home and Auto's Chicago operations. Even after borrowing funds to bolster its capacity to write business, it experienced very poor results from underwriting. The cause? Inadequate rates. Inflation caused medical and repair costs to escalate rapidly. Such costs were borne by the insurer, which had to live with the premiums its insured had paid for the coverage, even if they became inadequate. Another threat to insurance profitability was higher jury awards paid by insurance companies to insureds. These juries tend to be very sympathetic to claimants. Insurance companies can and do include estimates for such costs in their policy rates, but if costs rise dramatically during the year, the difference can result in subpar profitability. Offsetting those inflationary costs was an ongoing oil crisis, which created higher gasoline prices and led customers to take fewer long car trips. This in turn lowered accident frequency. Buffett told shareholders he was not as optimistic as some competitors that lower accident frequency would offset the inflation seen in repair and jury costs. A weakness in the accounting system at Home and Auto highlighted the impact data quality has on insurance profitability. Information was not brought to management's attention in a timely manner, and policies were being written at rates that did not adequately reflect the cost of doing business. Buffett assured shareholders the situation was being addressed. Home and Auto expanded into Florida and California as planned, though an assessment of the results through 1973 was too preliminary to determine its effectiveness. Investments. A large portion of Berkshire's investment portfolio resided on the books of the insurance group. The bear market that began in 1973, coinciding with an economic recession, negatively impacted Berkshire's investments. Over $12 million in unrealized losses that occurred during 1973 represented a distressingly large portion of the $67 million average common stock portfolio within the insurance group. Despite such large reported losses, Buffett expressed confidence in the portfolio. Nevertheless, we believe our common stock portfolio at cost represents good value in terms of intrinsic business worth. In spite of the large unrealized loss at year-end, we would expect satisfactory results from the portfolio over the longer term. Perhaps intentionally not stated in the letter to shareholders for fear of arousing nervousness, Berkshire invested significant sums during 1973. The insurance group's financial report showed that over $15 million in bonds and preferred stocks were liquidated in order to invest over $32 million in common stocks and $1.5 million in blue-chip stamps. One notable investment made in 1973 was $10.6 million for 467,150 shares in the Washington Post that declined to $7.9 million at year-end. Berkshire could make such investments because it had both the resources and ample capacity to do so. Diversified retailing. After 2 short paragraphs with the usual praise for Berkshire's banking subsidiary, Buffett turned his attention to a proposed merger with diversified retailing. If one had only been reading Buffett's reports to shareholders over the past 9 years, you might never have heard of diversified retailing. The company ran a chain of women's apparel stores in addition to a reinsurance business. The unusual reinsurance business line was the handiwork of Buffett, the controlling shareholder of Diversified. Buffett and Charlie Munger would weave such a complicated web of business lines and business ownership that the SEC would later investigate them for fraud. Their dealings were above board, of course, though most financial fraud is accompanied by intricate accounting maneuvers meant to cover up misdeeds. A merger would simplify much of the cross-ownership that got them into trouble in the first place. The proposed merger approved by Berkshire's directors would be funded by issuing 195,000 Berkshire shares. Because Diversified owned 109,551 shares of Berkshire, you can see how a regulator might begin to suspect something was awry. Dilution at Berkshire would be less than 86,000 shares. On 980,000 then outstanding Berkshire shares, dilution would come to less than 10%. Presumably, Berkshire would be receiving at least as much in business value as it was giving up. Buffett told shareholders that its Diversified most important asset is 16% of the stock of blue-chip stamps. Berkshire itself owned some blue-chip stamp shares directly. Post-merger, Berkshire's ownership in blue-chip would increase from 22.5% to 38%. With or without the diversified retailing merger, exceeding the 20% ownership mark required Berkshire to report its proportional share of Blue Chip's earnings on its financial statements. Blue Chip's year ended in February compared to Berkshire's calendar year. Berkshire had to decide which period to include. One option, blessed by Berkshire's auditors, was to use the earnings and ownership level as of Blue Chip's prior audit. This would mean including the 12 months ended February 1973 in Berkshire's results for the 12 months ended December 31, 1973. Buffett said that such an approach seemed at odds with reality, considering the 10-month lag. He chose to use the unaudited results of Blue Chip for the 12 months ended November 1973. Even though Berkshire auditors couldn't officially okay them, this choice resulted in just 1 month of Blue Chip's results falling outside of Berkshire's instead of 10. Buffett noted that Blue Chip had important sources of earnings power in its See's Candy Shop subsidiary as well as Wesco Financial. Wesco was a 54% owned subsidiary of Blue Chip that operated a savings and loan business. Charlie Munger would serve as Wesco's chairman for many years until it was brought under Berkshire's umbrella in 2011 transaction. Wesco and its subsidiaries will be discussed later in the book. Concluding the 1973 letter was a note on the Pulitzer Prize-winning Sun newspapers. That group was last mentioned by Buffett in the 1969 annual report, though because of its small size got little attention. Despite this, the paper earned a Pulitzer, the highest honor in newspapers, for exposing the incredible story of fraud at Boys Town, a local Omaha-based charity that was hoarding money but claimed poverty. Buffett praised the paper's management, journalists, and editorial staff for their achievement and signed off for the 9th time. 1974. Buffett wasted no time getting to the major driver of the relatively poor results achieved during 1974. Surprisingly, it was not the textile division. This time it was insurance. In his opening sentence to shareholders, Buffett shared that insurance underwriting had been dismal. Weakness was anticipated in his 1973 letter, but the extent of the 1974 reversal took him by surprise. Offsetting the weakness in insurance were quite satisfactory performance by both the textile group and the bank. the net result of which was a 10.3% return on beginning shareholders' equity for Berkshire as a whole. Results for 1974 underscored the value in having numerous sources of operating earnings, a benefit Berkshire lacked before Buffett transformed the company using his capital allocation skills. Textiles. Textiles achieved fleeting profitability in 1974 before signs of weakness appeared. The division operated at one-third of capacity, which would result in future operating losses in the coming year if sales volumes remained depressed. Despite this, the division's $2.7 million in operating income, though down somewhat from the $2.8 million posted a year earlier, was something to celebrate. As of 1974, the group primarily produced curtains, which were not necessities and thus sensitive to economic conditions. The ongoing recession caused consumers to defer purchases of such non-essential goods. Additionally, housing starts were down, which meant fewer windows needing curtains. If that wasn't enough, retailers were also trimming their inventories and making fewer purchases from Berkshire. Insurance. The confluence of competition, the trend of inflation running at approximately 1% per month, and several mistakes that came to light in 1974 caused insurance underwriting results to deteriorate significantly. Battling competition that was very wary to increase premium rates to combat the rising cost of paying its insureds, Berkshire pulled back writing what it saw as unprofitable business. Each line of business reported an underwriting loss. The combined ratio, which had been in profitable territory at or below 100% since entering that business, now jumped to 111%. The $6.9 million underwriting loss wiped out 3/4 of the cumulative underwriting profits made in Berkshire's short 7-year history. Premiums written and earned were $61 million, up 21% and 14% respectively. But Berkshire's insurance group was writing far less business than it could have been. Since 1970, when net premiums written to average equity peaked at 272%, this ratio had declined steadily to 88% by 1974. Whether due to a desire to maintain premium volume or simply because they had to, the industry continued to write unprofitable business. Berkshire intelligently remained on the sidelines. It had both the ability and the willingness to reduce its volume short-term to remain profitable long-term. Though general industry conditions and stiff competition hurt results during the year, nothing was more painful than self-inflicted losses. After telling shareholders of plans to expand into the Florida market, Buffett now informed his partners that the decision to expand home and auto to that state proved disastrous. Buffett calculated the financial cost of the mistake at $2 million, most of which was realized in 1974. He summed up the mistake in one sentence. In retrospect, it is apparent that our management simply did not have the underwriting information and the pricing knowledge necessary to be operating in the area. Still, there was reason for optimism. The home state group continued to grow premiums, up 9%, while getting a handle on costs, and the restart in Texas appeared to be working. Long-term success came with temporary setbacks. Berkshire had the patience and, perhaps more important, the capital strength to ride out the storm. Berkshire's advantage, largely by design, was its large capital base invested in high-quality assets. As noted earlier, Berkshire wrote just a fraction of its capital base each year in premium volume, far below its competitors percentage-wise. Though profitability was down, the group still reported net operating income during the year, thanks to net investment income more than offsetting the underwriting losses. Weak operating results during the year had one, if not positive, at least mitigating consequence. On a consolidated basis, Berkshire incurred no tax expense during the year, and in fact it booked a tax credit. Although textiles and banking were strong and generated taxable income, these earnings were reported with all of Berkshire for tax purposes. The tax loss in the insurance group was available to shield income from other parts of the business. The insurance group overall reported a profit, but the components of that profit were taxed differently. For example, it held certain tax-exempt issues, and its dividends were taxed at a lower rate. This meant it could use the underwriting loss to shield taxable income elsewhere within Berkshire. In later years, Berkshire would gain enormous similar tax benefits from owning utilities under the same corporate parent, maximizing every benefit of the conglomerate structure. Banking. Separate financials for the bank reflected the tax advantage it received as a subsidiary of Berkshire. On pre-tax, pre-securities gain income of $4.2 million, the bank accounted for just $220,000 of income tax, a rate of about 5%, and far below the federal statutory rate of 48%. This was a direct result of tax credits from the insurance group. Clearly, this low level of taxation was not normal, and the bank would have paid much more had its parent at the time not been Berkshire Hathaway. The benefit to the bank and Berkshire was real. Accounting. Being owned by a conglomerate clearly created tax complications. Perhaps for this reason, or to remove the effect of changing tax rates over time, Buffett frequently commented on and used pre-tax profitability in his analysis of business results. At the end of the 1974 annual report was a new section entitled Management's Discussion and Analysis of the Summary of Operations. This new section was mandated by accounting standards and contained additional details for readers of the financial statements. One subsection contained a chart titled Sources of Net Income, with data going back 5 years. The chart, reproduced in the appendix, separated each contributing source of income from corporate, administrative, and interest expense, realized investment gains, losses, and income taxes. Elsewhere, readers could see detail of the insurance premiums broken down by line. The section was largely a reproduction of the data Buffett had been giving readers all along. It would not be the first time Buffett was ahead of the accounting standards. The new supplementary report also contained a section explaining the difference between statutory and GAAP accounting for the insurance group. Insurance authorities use a separate accounting system to analyze insurance companies that focuses on the insurance company's real ability to pay its claimants. Its aim is not economic reporting, but conservatism. That conservatism was important to understand because it placed restrictions on how much business the insurer could write and how its assets could be invested. One of these adjustments was for deferred policy acquisition costs. These were the costs of acquiring new customers and included such expenses as brokers' commissions and marketing expenses. From an economic perspective, these expenses were assigned to the policies they sought to gain. As such, GAAP accounting placed some of the expense on the balance sheet as an asset, which was reduced over time as the insurer earned the policies. For statutory insurance accounting purposes, however, they were not included since the monies had already been spent and would not be available in the event the resources were required to pay policyholders. A reconciliation of Berkshire's statutory accounting surplus to that under GAAP for 1974 highlights many of the big differences between the two accounting standards. These included unrealized gains on equity securities, excess carrying value of subsidiaries, goodwill, deferred policy acquisition costs, mentioned above, excess statutory liability loss reserves, certain insurance receivables, other non-admitted assets, certain other tax effects and adjustments relating to depreciation and write-offs, for example. Diversified retailing. Disappointingly, the proposed merger with Diversified Retailing, which was approved by the directors of each company the prior year and put to a shareholder vote, had been terminated because of the Securities and Exchange Commission, SEC, hadn't given its okay. Shareholders would have to wait until 1977 for the deal to finally close. That didn't stop Berkshire from increasing its ownership in blue chip stamps to 25% at year-end. Listed at the end of the 1974 annual report were Berkshire's directors and executive officers. It stood out for the small number of individuals listed. Buffett as board chair and CEO of Berkshire, Ken Chase as president of Berkshire and COO of the textile group, Malcolm Chase Jr., retired former Berkshire chairman, and J. Vern McKenzie as VP, secretary, and treasurer. For a company with over $200 million in assets and annual revenues north of $100 million, it was a lean team. Buffett preferred it that way. Decade in review. Perhaps at no other time in Berkshire Hathaway's history did the company experience more change. Berkshire had seen dramatic ups and downs before as its textile business went through violent business cycles. But the change experienced in the decade ending in 1974 was noteworthy for its shift in business strategy and capital allocation. Rather than continue solely in textiles, Berkshire under Buffett was redeploying capital into new industries. Buffett was shaping Berkshire into not the best textile company, but the best company, period. The extent of the change Berkshire experienced during the preceding decade under Warren Buffett's leadership cannot be overstated. Once a dying textile business, Berkshire now had many sources of earnings power. Owners of Berkshire in turn owned an insurance operation, a bank, a newspaper, and, through blue chip stamps, an interest in a trading stamps business, another bank, and a candy company. Beginning the decade, year-end 1964, Berkshire was a textile company with $22 million of equity and diminished earning power. Such a sorry state of affairs weighed on the stock price, which traded between $8.50 and $13.50 per share during 1964, despite being backed by a book value of $19.46 per share. Fast forward a decade, and Buffett had nearly quadrupled Berkshire's consolidated equity. The stock followed suit, with the price during the fourth quarter of 1974 ranging from a low of $40 to a high of $49, down from a high of $93 during the first quarter of 1973, before the bear market did its damage. Berkshire's stock price and valuation at the end of the decade reflected the general pessimism of the bear market of 1973-74. Despite the substantial progress made building value in the underlying business, the stock traded at a lower price to book value than it did at the beginning of Buffett's tenure. See Figure 3.2 and 3.3. The capital allocation decisions made between 1965 and 1974 resulted in significant earnings, of which a portion was returned to shareholders in the form of dividends and share repurchases. The equity adjustments made in 1965 and 1966 and other minor adjustments made up the difference. To say that Berkshire had been transformed would be an understatement. Berkshire had a metamorphosis. Examining Berkshire's balance sheet in greater detail, we can see some of the major changes that occurred. Comparing 1964 to 1974, the reader will notice that the insurance group's assets and liabilities were now listed on Berkshire's consolidated balance sheet. See Table 3.15. Because of its size, the group was now presented on a consolidated basis. Essentially, everything was disaggregated and presented alongside the textile group, rather than just the equity component being presented separately, like the Illinois National Bank and Trust of Rockford and blue chip stamps. The marketable securities portfolio stands out first. Now totaling $136 million, this important asset made up almost two-thirds, 63%, of Berkshire's total consolidated assets. See Table 3.15. Offsetting these assets were the sizable sums on the liability side of the balance sheet, including the $73 million of losses and loss adjustment expenses, and the $22 million of unearned premiums. These two items, major components of the all-important float, were, and are, liabilities. However, they are liabilities without a specific due date and cannot be called by policyholders. The float was the result of work building and expanding the insurance group. Buffett saw the success of National Indemnity and wished to expand on it. Reinsurance was the first logical step. The home state companies were another logical expansion, as was the desire to expand beyond Home and Auto's base in Chicago into other urban areas. Both expansions were fraught with challenges and losses. They highlighted Buffett's entrepreneurial zeal and willingness to take calculated risks. The lessons learned during those expansionary years were crucial learning points for the entire insurance organization, Buffett included, and he was not shy about sharing his and the organization's failures in his annual communications with shareholders. Other important assets on the 1974 consolidated balance sheet were the $22 million investment in bank subsidiary, Illinois National Bank, and $16.9 million common stock of blue chip stamps. What about the textile division? We can make an approximation of the capital employed in the group based on the known information on the balance sheet and detail provided in the annual report. Comparing data from 1964 and 1974 in Table 3.13, we can see the capital employed in the business shrunk by $14 million, or 57%. Perhaps more important, capital efficiency was increased by over 52% as the division eked out more volume with less capital investment. Readers already familiar with Berkshire's history may wonder why there was no lengthy discussion of See's candies in this chapter given its importance. I have left this for later when Buffett discusses See's in his chairman's letter. In this way, the reader following along chronologically will have the same information shareholders had. As far as shareholders might have known at that time, Given the lack of disclosure other than minor details in the footnotes, See's was just one of many investments. Lessons, 1965 to 1974. 1. Capital allocation is a continuous, ongoing process. Not only must opportunities within an existing business be examined, options in entirely different industries must also be considered. If additional opportunities for investment are not available, management should consider returning capital to shareholders via buybacks and/or dividends. 2. Owners should focus on the rate of return they are earning from a business, not the dollar amount. Higher earnings or higher earnings per share can be achieved through a low rate of return, which does not serve investors well over the long run. 3. Satisfactory business results can be achieved without undue risk or leverage. Illinois National Bank. 4. Mistakes in capital allocation, such as the losses experienced in Florida and Texas in Berkshire's insurance group, do happen. The key is making sure bad investments don't put the larger enterprise at risk, learning lessons from those mistakes and communicating candidly with shareholders about them. Chapter 4, 1975 to 1979. Introduction. Warren Buffett began his second decade at the helm of Berkshire Hathaway with a company worth 4 times as much as it was when he acquired control of it in 1965. Monetary value, though, was not the only differentiator. Instead of a failing textile business, shareholders now owned a large, successful conglomerate consisting of an insurance operation that provided profits and excess cash, float, to invest in marketable securities, a bank, and a newspaper. Plus, through an investment in blue-chip stamps, it owned an interest in a candy company and had more float to invest, value that would accrue to Berkshire's full benefit when the two companies merged. This was a Berkshire shaped in Buffett's image, using his capital allocation skills and the resources and opportunities available to him at that time. The Berkshire Hathaway that would emerge from this second decade of work would also reflect this image, but with a much larger shadow due to its sheer size. See Table 4.1. Throughout the decade, beginning in 1975, Berkshire would expand existing, profitable operations, buy other operating businesses, and buy pieces of businesses via its investment portfolio. It would be forced to divest of its bank and intentionally shrink another banking operation to reduce risk. Different businesses helped with Berkshire's growth in different ways. While the textile division was being shrunk to allow Berkshire's diversification into more profitable lines of business, the insurance group was a platform for expansion through organic growth and acquisitions. The decade would also include notable changes in business relationships. 2 of the largest investments, diversified retailing and blue-chip stamps, would be merged into Berkshire, bringing with them important and valuable subsidiaries. Blue Chip would become another platform for building a portfolio of wholly owned operating businesses, all the while managing down its own dying trading stamp business. Through Blue Chip, Berkshire would come to own another bank, Mutual Savings and Loan Association, a steel warehouse company, another newspaper, and See's Candies. The candy business would shine brightly throughout the decade, though not without some difficulties along the way. The Berkshire that emerged from Buffett's second decade would be the result of the successful allocation of over $1 billion of capital. This result would come in part from great patience and fortitude in the face of economic recession of the 1970s, the large storm that hit the usually strong insurance industry during the latter half of the decade, record interest rates, troubles at the Buffalo News, and other challenges along the way. 1975. The beginning of the second decade of Buffett's control of Berkshire Hathaway was a challenging one. The previous year, Buffett had told shareholders that the outlook for 1975 was not encouraging. Now he reported that his forecast was distressingly accurate. The business produced the lowest return on equity since 1967, a bleak 7.6%. Even worse, profits included a one-time benefit from federal income tax refunds. True ongoing operating results had been lackluster. Amid the bad news came indicators of better days. The textile industry had shown some degree of rationality in 1975, with industry participants cutting back production rather than competing to the point of massive operating losses, like during prior industry slumps. Berkshire continued to increase its investment in blue-chip stamps. The big swing factor was insurance underwriting. Underwriting was hard to predict due to the actions of industry participants and the uncertainty of future loss claims. It could make or break any given year. Still, there were some favorable wins at Berkshire's insurance back that hinted of possible underwriting improvements during the year. Textiles. During the year, Berkshire acquired Wambeck Mills and Wambeck Dyeing and Finishing Company in Manchester, New Hampshire. On April 28, 1975, Berkshire purchased the company for $1.7 million, partially funding the purchase with $1.15 million of promissory notes issued by Berkshire at the parent company level. This followed a decade where Berkshire reduced production or sold off certain textile manufacturing locations. So why buy Wambeck? Buying a company in a dying industry doesn't make sense on the face of it, but a few factors likely influenced the decision. First, Wambeck was like the home fabrics division and focused on the more profitable finished woven products, primarily drapery and apparel. Buffett thought it could complement Berkshire's existing operations. Next, the purchase appealed to Buffett's instinct to acquire bargains. The purchase price for Wambeck was below book value, reflecting its diminished economic position. That means Berkshire paid less than what the net assets recorded in the books were worth, at least on paper. In the notes to the financial statements in Berkshire's annual report for 1975, a disclosure is made. To balance the purchase price against the book value of the company, no net property, plant, and equipment was carried on to the consolidated financials. By extension, no depreciation expense would be incurred either. This seems odd by today's accounting standards, but it was consistent with the accounting treatment at the time. Additionally, 1975 was a big year for the textile industry. The recession in 1974 hit textiles hard, but there were huge increases in the latter half of 1975. Many manufacturers reported going from operating 2 or 3 days a week to 5 or 6 days with 3 shifts a day. The below book value purchase price was a result of Wambeck's weak operating results. Wambeck was operating 55% of its looms at 50% of operating capacity. The business improved in the latter part of 1975, but the period leading up to Berkshire's purchase saw a lot of red ink. In fact, those losses resulted in a $2.6 million of unused net operating loss carryovers at the time of purchase, essentially tax credits available to offset any future income from Wambeck. While the headline textile revenue figure listed in the financial statements gave the appearance of an okay year, digging deeper told a more nuanced story. Berkshire did report an increase in sales of textiles during 1975, but because the current year included results from Wambeck, which hadn't been under Berkshire's ownership the prior year, sales results were worse than at first glance. See Table 4.4. If Berkshire had owned Wambeck all of 1974, revenues would have reflected a 22% decline. The significant decline in revenues notwithstanding, strong profits in the fourth quarter brought the results into the black for the year. This also proved that revenues and profits do not always correlate and can sometimes diverge quite drastically. Buffett concluded his update on textiles with praise for Ken Chase and his team and said they and Berkshire would look for ways to increase business without undue investment. Buffett considered it unwise to make major investments in new fixed assets in the textile industry due to the relatively low returns historically earned, a comment which seems to confirm the low purchase price indeed made the Wambeck acquisition appealing. Insurance. The property and casualty insurance industry had its worst year in history during 1975. We did our share, so Buffett began his report to shareholders about the insurance segment. Berkshire's insurance companies suffered disproportionately due to weakness in auto and long-tail lines. Insurance underwriting results suffered due to multiple aspects of one overall trend, inflation. 3 aspects were of particular concern. A surging general rate of inflation. This caused the cost to deliver on promises, i.e. to repair property and pay for medical costs, to soar above the level expected when the premiums were written. Social inflation was a growing problem. Juries were issuing large restitution payments to claimants at a far higher rate than had previously been experienced. To compound matters, those large awards led to more lawsuits and more restitution payments. Buffett summed this up nicely. Juries were, in effect, adding coverage to customers beyond what was paid for. Insurance companies had to pay out the awards and price future policies accordingly. Other, weaker insurance companies who underpriced or under-reserved went out of business. Their losses were effectively subsidized by other insurers through guarantee funds, comparable to today's Federal Deposit Insurance Corporation for banks. In the FDIC's case and in the guarantee funds case, industry participants, banks and insurance companies respectively, basically pay an insurance premium to cover failed firms. Challenges aside, all was not doom and gloom in insurance. The home and auto business was now included along with the home state companies under home state multiple lines. After a disastrous expansion into Florida, the business receded to its home turf of Chicago. Buffett wrote that adjusted for startup costs, the Texas United Insurance Company made outstanding progress. Cornhusker Casualty, the oldest and largest of the home state operations, turned in both higher premiums and, more importantly, a combined ratio under 100%. Expected premium growth for 1976 reflected an anticipated repricing of premiums to match the inflated costs rather than growth in the number of policies. Under normal circumstances, such a gain in volume would be welcome, but our emotions are mixed at present, Buffett explained. Overall, the insurance group reported a combined ratio of 117.8%, see Table 4.5. Its loss ratio, which had jumped from 62% in 1973 to almost 78% in 1974, creeped up to 81% in 1975. Together with expenses of 36.9%, likely reflecting some of the previously mentioned startup costs and higher relative fixed expenses on lower premium volume, results were truly horrific. The combined ratio was predicted to remain above 100% in 1976. Even though insurance underwriting and insurance investing are inextricably linked, they are also nonetheless separate. Buffett delegated the day-to-day underwriting to others while retaining the investing, meaning capital allocation, to himself. This two-pronged approach to operating the insurance businesses and evaluating their results is still in use at Berkshire today. Berkshire placed little emphasis on year-to-year realized and unrealized gains and losses. Buffett was rather looking for business results, no different than Berkshire's subsidiaries. Our equity investments are heavily concentrated in a few companies, which are selected based on favorable economic characteristics, competent and honest management, and a purchase price attractive when measured against the yardstick of value to a private owner. Like the two-pronged approach to insurance overall, the general investment criteria had remained steadfast. Banking. Eugene Abegg and Illinois National Bank continued to impress. During 1975, the bank had average loans of about $65 million, yet loan losses were a mere $24,000, or 0.04% of loans. That record is outstanding then and now. While one year may be an aberration, the long-term track record spoke for itself. In 1975, the bank earned over 2% on assets, compared to a fourth of that, or 0.5%, for the largest 30 banks in the country. A fan of history, especially business history, Buffett gave shareholders a glimpse into the beginnings of Illinois National. Eugene Abegg founded the bank in 1931 with $250,000 in capital and earned $8,782 during its first full year in 1932. Fast forward 44 years, and the bank was earning $3.5 million annually, with equity approaching $22 million. A compounded annual rate of return of 10.7%. That is even better than it seems since the bank paid regular dividends to owners over those years. Signing off the 1975 letter was a reminder of Berkshire's operating philosophy. A conservatively financed and highly liquid business, possessing extra margins of balance sheet strength, consistent with the fiduciary obligations inherent in the banking and insurance industries, which will produce a long-term rate of return on equity capital exceeding that of American industry as a whole. Under Buffett's control, that return on equity capital was 15%, compounded annually, a doubling every 5 years. 1976. After a very difficult 1975, the new year brought a pleasant surprise. Insurance underwriting, led by Phil Lesh of National Indemnity Group, turned in results that exceeded the most optimistic projections. Berkshire's overall operating earnings of $16 million reflected a return on equity of 17.3%, above Berkshire's long-term average of 15% in the Buffett era. Berkshire repurchased its own shares during 1976, see Table 4.6. Though the amount repurchased represented less than 1% of Berkshire's outstanding shares, it shed light on Buffett's view of the attractiveness of the stock, which continued to be priced attractively. Textiles. There was a dark spot among the good news, and unsurprisingly, it was in textiles. Returns on revenues and on capital were back to trend and inadequate. The Wambeck mill, acquired only a year earlier, was not pulling its weight. The entire group continued a long slide into economic oblivion. Still, Buffett believed reasonable returns on average are possible. He told shareholders that the textile group was an important source of employment in New Bedford, Massachusetts, and Manchester, New Hampshire. His words come across as conscious of the social ramifications of operating according to strict economic yardsticks that might not consider the people who depended on the plants for their livelihoods. Berkshire, even then, was guarding its reputation. As the textile business was shrinking, so too were the details of its operations in the financial statements. This was, of course, partly because Berkshire had grown significantly in size and scope into many other business lines. Some detail on textile inventories were provided, but revenues were now grouped into the net sales of manufactured products. This was probably due to the acquisition of K&W Products, a small automotive chemical company in California, and it now made sense from a financial reporting standpoint to report its finances with the textile group. Insurance. When assessing the performance of a conglomerate, component results must be analyzed. These parts often have different economic characteristics and performance. This was the case with Berkshire's subsidiaries. While the textile group faltered, the insurance group flourished. The industry, including Berkshire's insurance group, had improved, as shown in Table 4.7. Notably, the combined ratio dipped below 100%. Instead of having a float or capital cost of 17.8% of the premiums it earned, policyholders essentially paid Berkshire 5.4% for the privilege of holding their cash. Some insurers, then and now, are content to operate at levels above 100%, reasoning that the float, or money they get to hold and invest, will make up the difference. Berkshire always strives for superior underwriting results. While direct business, such as the auto and general liability lines, showed a marked improvement during the year as higher premiums covered costs, the reinsurance business fared slightly less well. Reinsurers insure other insurance companies, so their results lag behind those writing the direct policies. Consequently, Berkshire's reinsurance operations continued to feel the effects of a weak 1975 during 1976, with Buffett cautioning shareholders that the near-term outlook still is not good for our reinsurance business. The acquisition of a small reinsurance operation hinted at bullishness on the long-term prospects of reinsurance. The K&W Products Manufacturing Company, described earlier, included a sister operation engaged in the reinsurance business and an insurance brokerage. In January, Berkshire acquired Kirkling Reinsurance Corporation, also headquartered in Nebraska. The company assumed excess business from National Indemnity's reinsurance arm, about $1 million premium volume annually. The $2 million purchase price was equal to book value. Home state operations were another bright spot. Premiums grew 66%, and Berkshire planned to form another home state operation during the year. The home and auto business in Chicago moved to a 6-month direct bill policy, which allowed more frequent repricing and therefore the ability to correct underpriced policies. Overall, Berkshire expected a better year in 1977, though concerns about continued economic and social inflation remained. Additionally, the significant industry rebound to profitability during the year was a siren call that competition might again drive down profitability. Investments. A new table appeared in the annual report detailing equity investments, common plus preferred, with a cost over $3 million. The combined portfolio totaling $75 million at cost, with Government Employees Insurance Company, GEICO, accounting for nearly a quarter of its $23.5 million, $19 million in convertible preferred stock and $4 million in common stock. Buffett had continued to follow the company after first learning about it as a student at Columbia Business School and understood what made the company special. Geico had strayed beyond its core business of insuring above-average drivers, losses mounted, and the market concluded there was a real risk the company wouldn't make it. Buffett's insight was that the company's core business would allow it to survive. The size of the Geico investment presaged the starring role the company would ultimately play in Berkshire's future. Another notable investment listed in the table was the $10.6 million investment in the Washington Post Company, first purchased in 1973. Berkshire's investment in blue chip stamps was not included in the table. Berkshire's $27 million investment was carried on the balance sheet separately since it owned about 33% of the business. Berkshire first invested in blue chip stamps in 1971 when it owned 6% of the company. Banking. Buffett, as usual, had good things to say about Berkshire's banking operations, and 1976 was no exception. Perennial praise for Eugene Abegg was followed by a financial reporting of its success. The bank continued to earn 2% on assets while maintaining high levels of liquidity and paying out maximum rates of interest to depositors. The only negative factor that was on Buffett's mind concerning the bank was its impending divestiture. New banking regulations required Berkshire to divest its star asset by the end of 1980. 1977. Buffett led off the 1977 letter to shareholders with a note on how he viewed capital gains and losses. While too much attention should not be paid to the figure in any single year, over the long term, the record is of significance. He wanted to remind shareholders to think like owners, that is, long term. He also continued his practice of tempering expectations. Buffett cautioned shareholders to view Berkshire's 37% increase in earnings per share as considerably less impressive than it might appear at first glance, because beginning capital was up 24%. By turning the attention to the rate of return on shareholders' equity, not earnings per share, Buffett was calling out a mischievous practice that continues to this day. We find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding, he wrote. Berkshire's results were impressive nonetheless. Weighed down by its roots as a textile company, Berkshire's 1977 results were that much more impressive. Meanwhile, blue chip stamps and the insurance group continued to shine. Berkshire's repurchase of its own shares was again relegated to the footnotes of the financial statements. Perhaps due to the relatively small amount, about 1/4% of outstanding shares, Buffett didn't think it worth mentioning. See Table 4.9. The price paid implied a valuation higher than that of the previous year, but still below book value. Textiles. Berkshire remained in textiles despite its shrinking size and dismal prospects. Of its $379 million of identifiable assets at year-end 1977, just $22 million were in the textile division. Still, Buffett put himself in the shoes of a minority shareholder and asked the question, why was Berkshire continuing to operate the textile group when it seemed to present nothing but problems and where opportunities clearly existed to redirect the capital elsewhere? He then answered himself, our reasons are several. 1. Our mills in both New Bedford and Manchester are among the largest employers in each town, utilizing a labor force of high average age, possessing relatively non-transferable skills. Our workers and unions have exhibited unusual understanding and effort in cooperating with management to achieve a cost structure and a product mix which might allow us to maintain a viable operation. 2. Management has also been energetic and straightforward in its approach to our textile problems. In particular, Ken Chase's efforts after the change in corporate control took place in 1965 generated capital from the textile division needed to finance the acquisition and expansion of our profitable insurance operation. 3. With hard work and some imagination regarding manufacturing and marketing configurations, it seems reasonable that at least modest profits in the textile division can be achieved in the future. The fate of textiles was coming, but not for several more years. Insurance. Berkshire bought National Indemnity and National Fire and Marine for $8.6 million in 1967, when it had annual premium volume of $22 million. A decade later, the insurance group had grown to combined premium volume of $159 million. More impressive was that this was done without the issuance of any shares of Berkshire stock. In fact, it had repurchased shares during this period. Berkshire founded or acquired for cash several insurers during the preceding decade. 1970, Cornhusker Casualty Company. 1971, Lakeland Fire and Casualty Company. 1972, Texas United Insurance Company. 1973, the Insurance Company of Iowa. 1977, Kansas Fire and Casualty Company. The newest addition to the Berkshire family of insurance companies was Cypress Insurance Company, acquired in late 1977. Cypress in South Pasadena, California, was writing about $12.5 million in workers' compensation volume annually. Although National Indemnity had its own workers' compensation operation, Cypress and National Indemnity would operate independently by utilizing different marketing strategies. Buffett was not one to make any changes to what he considered a first-class operation. First class did not mean perfect. Buffett pointed to 4 mistakes made by Berkshire's existing insurance operations to date. The surety operation attempted in 1969, a money-losing venture in aviation insurance, the failed expansion attempt of home and auto into Florida, and attempting to build out workers' compensation in California, which was now back in action and proceeding in earnest. But he did not linger on them. It is comforting to be in the business where some mistakes can be made, and yet a quite satisfactory overall performance can be achieved. In a sense, this is the opposite case from our textile business. Buffett appreciated the insurance group's generally high performance, but was more interested in explaining results and looking ahead than highlighting stellar performance. The wins in insurance and underwriting were squarely behind us. Removed from the disastrous years of the 1974-1975 period, which resulted in competitors and capacity leaving the market, rates were now on the rise, offsetting inflation, now rising at 1% per month. Buffett also foresaw a return to stiff competition in future years as high prices lured others back into the market. As markets loosen and rates become inadequate, we again will face the challenge of philosophically accepting reduced volume. Berkshire's insurance operations didn't operate in secret. There were no real barriers to entry, hence wild swings of competition waxed and waned. To remain competitive over the long haul, Berkshire would require unusual managerial discipline to focus on profitability, not volume. In 1975, the reinsurance group wrote just under $10 million of premiums. Fast forward to 1977, and its volume was $24 million. Although underwriting profitability was not met and had an underwriting loss in each of the 3 prior years, it still generated large sums that were available for investment. Reinsurance is the sharing or offloading of risk. Essentially, insurers pay part of the premiums they collect from policyholders to a reinsurance company, and in exchange, the reinsurance company agrees to share in losses and/or cover losses above certain limits. This kind of business came in spurts, and those spurts could come in quite large chunks. The liabilities assumed were often of longer duration. This meant Berkshire could invest the float for a longer period than, say, automobile insurance, which was written on a 6 or 12-month basis and paid out about as quickly. Investments. Insurance investments at cost grew from $135 million to $253 million over the preceding 2 years. Fueling this growth was capital gains on investments and net underwriting profit, along with large increases in premium volume and the consequential float generated. Chief among these float generators was reinsurance. The chairman's letter now detailed equity holdings of the insurance group for each holding over $5 million of market value. The combined value of Berkshire's investment in Geico common stock and convertible preferred stock still represented almost a quarter of the $181 million portfolio of equities. See Table 4.11. The remainder was comprised of simple, easy-to-understand businesses, including aluminum companies, advertising agencies, and communications broadcasting. Buffett used capital cities to illustrate a finer point to shareholders about how he thought of Berkshire's part ownership in companies via ownership of their publicly traded shares. In 1977, Berkshire paid $10.9 million for its stake in Capital Cities. Earnings on those 220,000 shares amounted to about $1.3 million. However, only $40,000 of those earnings, the dividend Capital Cities paid Berkshire, showed up on Berkshire's bottom line. Because of the way accounting works, Berkshire reported as income just a tiny fraction, the dividend, of the true economic earnings, the $1.3 million. The accounting was obscuring the economic reality. Why, asked Buffett, would Berkshire prefer to seek out a wholly owned business to buy like Capital Cities when such an investment would cost at least twice as much as an investment in Capital Cities common stock? We could obtain a better management result through non-control than control. This is an unorthodox view, but one we believe to be sound. He continued, excellent business results by corporations will translate over the long term into correspondingly excellent market value and dividend results for owners, minority as well as majority. Berkshire would continue to use economics as its guide and explain to shareholders the shortfalls of conventional accounting. Banking. Buffett had nothing but ongoing praise for the now 80-year-old Eugene Abegg and the Illinois National Bank. This time he punctuated it with some more facts and figures. Since Berkshire purchased the bank in 1969, it had paid Berkshire $20 million in dividends. Berkshire paid $17.7 million for the bank, meaning it had recouped its investment and more in dividends and still owned an asset generating good returns. Abegg asked that year that a successor be brought in. Peter Jeffrey was brought in as president and CEO from Omaha-based American National Bank. Abegg would continue as chairman. Merger with diversified retailing. The benefit of hindsight allows us to see the effects of different accounting methods on the presentation of the same economic results. Since the diversified retailing merger was not completed until December 30, 1978, we have two views of the 1977 Berkshire Hathaway financial statements, once from the original 1977 report and another from the post-merger report for 1978 that contained a comparison to 1977. More detail on this merger will be presented in the following segment. For now, it is worth noting a few of these changes as they apply to 1977. The merger caused blue chip stamps to become fully consolidated with Berkshire's financials rather than its equity being presented on one line on the balance sheet as an asset and its earnings similarly on one line on the income statement. In effect, the revised presentation of the financials illustrated to Berkshire shareholders Buffett's notion of look-through earnings. Instead of just earnings, shareholders had much more detail on revenues, expenses, and other items. Table 4.12 highlights a few key figures from Berkshire's financial statements for 1977 as originally reported and as restated the following year. From the 1978 financial statements, Diversified Retailing had $27.1 million of equity at the beginning of 1977. Since it earned $3.7 million in 1977, we would have expected Berkshire's equity to reflect a $30.8 million increase, beginning equity plus retained earnings. But it didn't. It increased just $12.8 million. Why? Part of the reason was that Diversified Retailing had itself repurchased shares prior to combining with Berkshire. These repurchases amounted to approximately $1.2 million, above and beyond those made by Berkshire itself during the year. But the primary reason was that each company owned a piece of the other. In combining the two companies, the cross-ownership needed to be reconciled and eliminated. Accounting is, most often, logical, but it can be messy. 1978. Late in 1978, Berkshire finally completed the merger with Diversified Retailing and simplified some of the Byzantine ownership between the two companies and the major shareholders. It was a long time coming. The merger was originally proposed in 1973, but the deal was first called off due to an SEC investigation. Finally, on December 30, 1978, Berkshire Hathaway and Diversified Retailing Company merged as one. Diversified Retailing operated on a parallel course to Berkshire throughout the mid-1960s and 1970s. Diversified was a holding company formed on January 31, 1966, by Warren Buffett, Charlie Munger, and their friend and future Berkshire director, David Gottesman. Buffett's investment partnership, Buffett Partnership Limited, owned 80%, and Munger and Gottsman each owned 10%. They planned to use the company to acquire retailers. The first acquisition was Hochschild Kahn, a lower-tier department store in Baltimore, purchased for $12 million, using $6 million of debt early in 1966. Buffett and his partners quickly realized the many challenges and pitfalls of department store retailing. Hochschild Kahn was sold in December 1969 for $11 million. An outstanding issue of debentures with restrictive positions and tax considerations resulted in Diversified retaining the proceeds of the sale. That capital was ultimately invested in blue chip stamps and the formation of Reinsurance Corporation of Nebraska in 1970, later named Columbia Insurance Company, which took reinsurance business off the books of National Indemnity. In 1974, through Columbia, Diversified also bought Southern Casualty Company, which wrote workers' compensation insurance in Louisiana. The major operating business at the time of the Diversified-Berkshire merger was another department store. Diversified Retailing paid $6 million for Associated Retail Stores Incorporated in April 1967. Berkshire now owned 100% of Associated Retailing, a chain of 75 women's apparel stores operating under various names. Buffett, always a fan of business history, gave a brief background. Associated was launched in Chicago on March 7, 1931, with one store, $3,200, and two extraordinary partners, Ben Rosner and Leo Simon. After Simon died, Rosner operated the business alone, and it faced many challenges inherent in retailing. Buffett said, "Ben's combination of merchandising, real estate, and cost containment skills has produced an outstanding record of profitability with returns on capital, often in the 20% after-tax area. Associated accounting for a fraction of Berkshire's consolidated operating earnings, but Buffett cherished his association with Rosner, who was 75 years old and still going strong. The Berkshire Diversified merger was a business marriage, and like a traditional marriage, was beneficial to shareholders, but not without its complexities. As married couples know, no matter when vows are taken, it could be January 1st or December 31st, the Internal Revenue Service views the couple as having been married throughout the whole year. Accounting principles generally work the same way, with one exception. Instead of looking back 1 year, accounting conventions at the time required the assumption that both companies had been one since their formation. Buffett did his best to explain some of the changes for the shareholders not well versed in accounting intricacies. For one, shareholders comparing the 1977 annual report to figures of the 1978 report for 1977 would have seen very different numbers for revenues, expenses, assets, liabilities, and other items. Select figures are presented below in Table 4.13. See the table at the end of the 1977 segment for the full presentation. Secondly, Berkshire's ownership investment in Blue Chip was now 58%, and this meant that Blue Chip's accounts would be fully consolidated. Prior to the merger with Diversified Retailing, it was included as one line on the balance sheet and income statement. The net effect of all this accounting maneuvering was the obfuscation of the financial statements. The merger consolidated many different businesses, some wholly owned and some partly owned. Buffett said this combination tends to obscure economic reality more than illuminate it. In fact, it represents a form of presentation that we never prepare for internal use during the year and which is of no value to us in any management activities. For this reason, Buffett included separate financial disclosures on the various segments of the business that shareholders and managers alike would find useful. This was Buffett imagining himself in the shoes of shareholders and providing the information he would want if roles were reversed. The data was presented in the chairman's letter and focused on the income statement. No balance sheet information was provided. The table was entitled Sources of Earnings and began in the 1978 report with a comparison to 1977. Presented this way, the information was very useful at assessing the various operating businesses. The Sources of Earnings table, Table 4.2, is reproduced here. Importantly, the table stripped away much or all of the noise. Items such as capital gains and losses, taxes, and later amortization of goodwill were presented as separate line items. This left the economic results of each business largely unobscured by accounting conventions that Buffett, rightly, thought twisted reality. To this day, Berkshire presents its operating results in a similar fashion, though the categories have been renamed and broadened to accommodate the growing roster of businesses. Insurance. The insurance group once again wrote to an overall combined ratio below 100%. Remember, a ratio below 100% means the operation earned a profit on top of any profits made by investing the float. For the insurance group in 1978, this translated into an underwriting profit of $3 million. That was on top of net investment income of almost $20 million and ignores gains on the sale of investments. Buffett called the 3 years from 1975 to 1978 a bonanza for the industry with good premium growth and low loss ratios. Indeed, it was a bonanza for Berkshire as premiums written and earned doubled over that time. There were reasons not to over-celebrate. For one, the home state operation had a disappointing year, which was that much worse against the backdrop of profitability elsewhere. The loss was in part due to both storms that hit the Midwest and subpar underwriting. The workers' compensation line also had a difficult year due to continued cost increases related to increasingly large jury awards that its solid premium growth couldn't cover. Reinsurance also reported a loss, but the long-tail nature of its business and its long-duration float made the loss less painful than that of the primary insurers. Buffett's eye and pen were pointed to the future. Such good results for the industry over the prior 3 years could only mean one thing: a return to lower profitability as competitors entered the market and cut rates. Still, he was optimistic on the longer-term outlook for insurance. Berkshire had excellent managers that possessed the ability and willingness to write policies that were profitable, regardless of volume. Berkshire would continue to buy and build insurance businesses, since the rewards for success in this field can be exceptional. They most certainly were. Investments. In addition to Berkshire's significant investment in wholly owned insurance businesses, it also had a large investment in another insurance company via its equity portfolio. Safeco, comprising almost 12% of Berkshire's insurance equities portfolio of $221 million year-end 1978, was Berkshire's third largest individual equity investment behind Geico, 17%, and the Washington Post, 20%. Buffett had high praise for Safeco, calling it probably the best property and casualty insurance company in the United States, a much better insurance operation than our own. Berkshire's investment was made below book value, which meant Berkshire acquired its interest below the cost to even build a similar business from scratch. According to Buffett, other less well-run insurers had been purchased by others for much higher than 100 cents on the dollar. Buffett was content to let Safeco's management, who had proven themselves highly capable of operating the insurer, run the operation without interruption. When he found good managers, he let them be, as he knew he was not perfect. Some of our expansion efforts, largely initiated by your chairman, have been lackluster. Others have been expensive failures. Berkshire would be better off economically if Buffett did not let his ego come into play. Textiles. There is not much to say on textiles as it relates to the business and industry itself. The brutal economics were still at work. The business was fading relative to its own historical record, even more so relative to the diverse and growing stable of businesses now under Berkshire's control. Still, for shareholders reading Buffett's letters, his comments offered clues to Buffett's thought process. Buffett began by commenting on the low return of 7.6% in textiles. It was produced by $1.3 million of after-tax earnings on $17 million of capital employed in the business. Yet even this calculation was generous. The plant and equipment in the textile group was heavily depreciated on the books, though it retained its usefulness. In other words, to replace the equipment would cost much more, and therefore the textile group's balance sheet showed a bargain cost for its fixed assets. The economics were even worse than at first blush. Even with this lower than economic cost, capital turnover, revenues to capital, was very low, reflecting required high investment levels in receivables and inventory compared to sales. This in and of itself would not be a problem if it weren't for the low margin on revenues. After all, the revenue-capital ratio multiplied by the profit-revenue ratio equals return on capital. The ratio can be low on one side if it is offset by a higher ratio on the other, but low on both sides equates to mediocrity. Buffett then listed several remedies to improve the situation. Differentiation of product, lowered manufacturing costs through more efficient equipment or better utilization of people, redirection towards fabrics enjoying stronger market trends, etc. The problem was Berkshire's textile management, as well as everyone else in the industry, was trying those same things. Since the textile operation had no competitive advantage, if anything, it had a competitive disadvantage, Buffett summed up the ruthless economics at work. As long as excess productive capacity exists, prices tend to reflect direct operating costs rather than capital employed. I believe Buffett uses this ultra-simplified framework for all his business experience. It is just the start of the analysis, of course. How much capital is needed in the business? What are profit margins? The investor then pays a price-capital employed ratio that determines his or her going-in rate of return. Buffett then thinks through how capital levels might change in the future and what profit margins might do, all through the lens of barriers to entry and competitive advantage. Textiles were a lesson on how hard things could get. Blue chip stamps. It is a fitting time to examine Berkshire's history with blue chip stamps, since the merger of Diversified Retailing and Berkshire Hathaway meant blue chip would be consolidated into Berkshire's financials and much of the finer detail would be lost. Berkshire's share grew from a modest 6% ownership in 1971, totaling $4 million, to a significant 36.5% ownership in 1977, totaling $36 million. See Table 4.15. The diversified merger brought it to 58% of the company. Over 8 years, blue chip became an increasingly important asset to Berkshire shareholders. At the end of the merger, blue chip subsidiaries represented 35% of Berkshire's earnings. The merged operations had many operational similarities. Like Berkshire Hathaway, blue chip was a company undergoing transformation. An examination of select data, see Table 4.16, reveals how blue chip changed over a relatively short period. Blue chip replaced income from its original business line of trading stamps with income from acquisitions unrelated to the dyeing stamp business. It was the Berkshire Hathaway playbook implemented by the same capital allocators. The blue chip that existed as of 1971 was the same business that had always been, trading stamps. The company sold trading stamps to 23,000 retail locations across Arizona, California, Nevada, and Oregon, which in turn provided them to customers as a promotion. The customers could redeem the stamps for products or cash at any one of Blue Chip's 89 redemption stores. The business was very much like insurance, where cash was received ahead of product delivery. Like an insurer, a trading stamp company could make money not only from its products, but by investing the cash it held in the meantime. The majority of its assets at year-end 1971 were invested in marketable securities. Those assets were funded by the float inherent in the unredeemed trading stamps, which were carried on the balance sheet as a liability. The remainder of the assets were funded by long-term debt and equity. Fast forward to year-end 1978, and Blue Chip's financial picture had changed significantly. A look at the income statement revealed the dramatic decline in trading stamp revenues over the preceding half-decade and the corresponding growth of other, newer subsidiaries. What capital allocation decisions were made to create such a transformation over 8 years? Blue Chip's balance sheet shared characteristics of Berkshire's higher-quality insurance companies, but its operations faced challenges more akin to textiles. Stamp service revenues reached $126 million in 1970, and that would prove to be the high watermark. Its business faced competition not only from other trading stamp and promotional companies, but from the retailers themselves who introduced discount merchandising. The 1978 Blue Chip Stamps annual report also pointed to the 1973 gasoline shortage, which caused many service stations to eliminate stamps entirely. As Buffett and Munger acquired a greater interest in Blue Chip over time, the two men came to control capital allocation decisions of the company. They recognized the continued decline in the trading stamp business and worked to reallocate Blue Chip's significant assets and liquidity into higher returning businesses. See's Candies. The first such reallocation was the acquisition of See's Candy Shops Incorporated. Between January 3, 1972 and March 4, 1972, Blue Chip acquired 93% of See's. The ownership increased to 99% on March 3, 1973. The purchase price was $34.7 million, but excess cash on its balance sheet brought the effective purchase price lower. See's represented Buffett's first time paying a high multiple for a business, and he attributes the decision to Charlie Munger's insights. Munger convinced Buffett it was worth the high multiple since the underlying business was so good. See's was earning over 50% pre-tax on tangible capital. Even after paying 3 times the underlying capital in the business, Blue Chip earned a satisfactory return. And if Seas could expand, which it turned out it could, though slowly, the incremental returns would enhance the initial economics of the purchase. As a bonus, this high-return business had protection against inflation. Since 1972, when Blue Chip bought Seas, pre-tax earnings grew from $4.2 million to $12.6 million with very little incremental investment. It did not take long for Buffett to realize the full potential of Seas and the potential pitfalls. In a letter to CEO Chuck Huggins in December 1972, Buffett urged Huggins to create a narrative around the Seas brand in order to protect its image. The surroundings in which our candy is offered affect potential customers' mental and even gastronomical impression of our quality, he wrote. Comparing Seas to Coors beer, which benefited from its availability solely in Colorado at the time, Buffett said, "We might be able to tell quite a story about the little kitchen in California that has become the kitchen known round the world." He thought Seas should tightly control all aspects of marketing and distribution and highlight its insistence on fresh ingredients rather than have it displayed alongside inferior products. It should be hard to get, available only periodically, and then, to the consumer, apparently only in limited quantities. Over time, Buffett would come to appreciate Seas not only for the business it was, but the education it provided him on recognizing the inherent value in high-quality businesses and their limitations. It would not be a stretch to say the lessons from Seas would shape the future of Berkshire Hathaway. Buffett will become more at ease paying higher multiples for businesses with protected economic positions. He would later credit his experience with Seas for allowing him to see the value in Coca-Cola, a major investment made in the next decade. Seas would also become a training ground of sorts for Buffett. The high returns on capital enjoyed by Seas naturally created a desire for expansion. The numerous attempts and mixed success over the years to expand Seas beyond its protected West Coast niche would provide Berkshire's capital allocators with first-hand evidence of the boundaries of economic moats. Considering this educational aspect and the turning point it represented in Buffett's investment philosophy, Seas may well have been one of Buffett's best investments. Wesco Financial Corporation. Blue Chip's next major subsidiary was Wesco Financial Corporation. Blue Chip began acquiring shares in 1973, and by the end of that fiscal year, it owned 21.9% of the company. After it sought and obtained approval to increase ownership beyond 25%, Blue Chip purchased an 80.1% stake in Wesco over the next 5 years. Amassing that stake hadn't come easy. To get there, Buffett and Munger convinced Wesco's controlling shareholder, Elizabeth Caspers Peters, daughter of Wesco's founder, to nix the deal to sell to another bank and instead sell to them. Wesco was the holding company for a bank, Mutual Savings and Loan Association. As of 1973, Mutual Savings operated out of 10 locations across 4 California counties and primarily provided real estate loans to individuals. It financed its $452 million balance sheet, including a $390 million loan portfolio, mainly with savings deposits. By 1978, Wesco had opened 6 new branches in Southern California. Its asset base at year-end 1978 was $646 million, including $465 million of loans that were financed by $488 million in savings deposits. Throughout this time, Wesco also owned its headquarters location in Pasadena, which included third-party tenants. Why was Wesco an attractive investment? Wesco appeared to be a well-run operation with a history of satisfactory returns. It probably helped that it was headquartered in Charlie Munger's figurative backyard in Pasadena, California. Based on Blue Chip's original purchase price for 21.9% of Wesco, the company was valued at just 0.56 times its underlying book value at the time of purchase. See Table 4.18. By 1978, the company was earning $11.7 million pre-tax, a 30% return on Blue Chip's aggregate investment. The Buffalo Evening News. The third major acquisition was the Buffalo Evening News. On April 15, 1977, Blue Chip acquired the paper for cash, in addition to the assumption of pension liabilities. The purchase was partially financed with a $30 million bank loan, which was repaid to $13.5 million by year-end 1977. The Buffalo News, as it later came to be known, operated a weekly newspaper in Buffalo, New York. At the time, it was a 2-newspaper town with The News' chief competitor being the Courier Express. The Buffalo News had the highest percentage of circulation among newspapers in upstate New York, with 2/3 of households subscribing. It published 6 days a week. The Courier Express published the dominant Sunday paper. Buffett's investment thesis was simple. The two-newspaper town was soon destined to become a one-newspaper town, and with the Buffalo News being stronger financially, it was more likely to survive. Buying in at book value meant that if such a winner-take-all situation occurred in Buffalo, Blue Chip, Berkshire, and Buffett and Munger would win big. Buffett got early signs his prediction would come true. The Buffalo News made plans for a Sunday edition in 1977, not long after the purchase. It was soon hit with a lawsuit that lingered until one of the papers went out of business. Though things ultimately worked out in favor of the News, at the time the situation was precarious and not at all certain. The first 8 months Blue Chip owned the paper, April to December 1977, it earned just $751,000. In 1978, it lost $2.9 million. The red ink was destined to flow for a while. After the diversified retailing merger with Berkshire Hathaway, Blue Chip subsidiaries became much more important to Berkshire's overall success. Because of the varying degrees of ownership at each subsidiary level, and there were many, determining the individual impact on the economic success of Berkshire became that much more difficult. This is why a new table appeared in Buffett's 1978 Chairman's Letter, see Table 4.2. This table showed the operating earnings of each subsidiary business as adjusted for Berkshire's ownership interest and irrespective of its parent company. In this way, Berkshire shareholders could assess for themselves how much emphasis and attention to place on each source of Berkshire's earnings. With Buffett and Munger using Blue Chip as a platform for expansion, understanding the impact on Berkshire was important. Buffett was once again putting himself in the shareholders' shoes. Like Berkshire, Blue Chip had transformed itself from a dying single-line business into a diverse enterprise with multiple sources of earnings and valuable assets. Buffett and Munger were using their capital allocation skills to shape Blue Chip in Berkshire's image. 1979. Changes to accounting rules necessitated another lesson on accounting in 1979. The prior year required an update due to the complexities surrounding the merger with Diversified Retailing. This time it was the insurance group's accounting that required some explaining. Specifically, the accounting rules regarding marketable securities were changed to record values at market rather than at the lower of aggregate cost or market. The result was a substantial increase to reported equity. The resulting change caused the insurance group's 1978 equity, as shown on the balance sheet, to increase $61 million to $204 million. Nothing had really changed from an economic perspective. To confuse things even more, the accounting change only applied to insurance companies. This meant that Blue Chip Stamps, which was fully consolidated with Berkshire, reported its equity investment the old way at the lower of aggregate cost or market. The same security owned by Berkshire's insurance companies and Blue Chip would therefore be reported at two different values. Shareholders were therefore given the information on aggregate cost and market values of securities in the footnotes to the financial statements regardless of where they were held in Berkshire. Buffett reminded shareholders how he viewed Berkshire's short and long-term operating performance. He took the view that operating earnings prior to any securities gain and losses was the correct numerator for any calculation. For the denominator, he used the prior year's ending equity with securities valued at cost, not market. The equation is shown in equation 4.1. The rationale was to provide the most accurate representation of managerial performance since a decline in equities valued at market would unduly depress the denominator and make performance the next year look artificially high. Conversely, a strong year for capital gains would cause good operating performance to look less impressive than it might otherwise have been due to a larger denominator. Long-term, Buffett looked to include everything, all capital, gains, losses, and any one-time or non-recurring items. He would also use securities valued at market for the calculation. Buffett warned against measuring results with earnings per share. The primary test of managerial performance is the achievement of a high earnings rate on equity capital employed, without undue leverage, accounting gimmickry, etc., and not the achievement of consistent gains in earnings per share, he wrote. Some real numbers summed up the achievements since 1964. On September 30th, 1964, the then year-end, Berkshire's book value was $19.46 per share. At year-end 1979, that figure, again with securities valued at market, was $335.85 per share, a compounded annual gain of 20.5%. Though certainly a good result, Berkshire's 20.5% rate of return was insufficient to produce real gains in purchasing power if inflation continued running double digits and taxes remained at current levels. One must ask the question, what was the alternative? If a 20% return was insufficient, what other investment at the time could have maintained or grown purchasing power in a world of high inflation? Buffett had no solution to this problem other than to use opportunity cost as his guide. Sources of earnings. The new table presented in the chairman's letter provided shareholders with a wealth of direct and meaningful information on Berkshire's operating performance throughout the year. Buffett was again role reversing and giving shareholders information he would want if he were in their shoes. What a story it told. See Table 4.2. Textile earnings, once the sole source of Berkshire's earnings, generated less than 4% of the nearly $47 million of earnings before taxes and securities gains, but after interest. The largest source of earnings power was in the insurance group. See's Candies, the Illinois National Bank and Trust, and Mutual Savings and Loan were the only subsidiaries after insurance whose earnings contributed 10% or more to Berkshire's pre-tax earnings. Sharp-eyed readers would have noticed a new business reported in the table in 1979, Precision Steel Warehouse Incorporated. An 80% owned subsidiary of Blue Chip contributed almost $1.5 million to Berkshire's earnings in 1979. In the letter to Blue Chip shareholders included as an appendix to the Berkshire Annual Report, Chairman Charlie Munger reported that Blue Chip purchased its interest in the steel company in February 1979 for $15 million. Writing to Blue Chip shareholders, Munger wrote, "A steel service center business may strike some of our shareholders as a peculiar addition to a candy company, even one already joined to a savings and loan business. However, Precision Steel shares an extremely important quality with See's, a company-wide culture of constant concern for customer interests and fair dealing. Both Munger and Buffett were concerned about not the profit click. Both Munger and Buffett were concerned not about the product per se, but about businesses they understood and that had good economic characteristics. Candy or steel, it did not matter. The summary table showed Berkshire's creditors they had little to worry about. Earnings covered interest almost 9 times over, and the $52.6 million of earnings before interest would have been nearly enough to pay off all of Berkshire's direct financial debt. To be fair, the earnings figure was a look-through number that accounted for Berkshire's share of all underlying earnings as adjusted for its ownership percentages. A corresponding balance sheet look-through number was not provided. Berkshire's unconsolidated ownership interest had some debt of their own, which, under a proper analysis, would be accounted for. The main point is Berkshire's creditors were very safe because they had a debtor with a large and growing stream of earnings on top of a conservatively financed balance sheet. Textiles and retailing. Given the gloom associated with textiles, the fact that textiles and retailing were combined under the same heading likely would not be comforting to a manager. Yet Buffett had praise for Ben Rosner, head of Associated Retailing Stores, who continues to pull rabbits out of the hat. Big rabbits from a small hat. The praise also gave shareholders a glimpse into The praise also gave shareholders a glimpse into Buffett's thinking on earnings. Cash was king. Those earnings produced by Associated Retail were realized in cash and not in increased receivables and inventories as in many other retail businesses. Insurance. Insurance underwriting again turned in a profit, meaning Berkshire's cost of float was negative, but Berkshire was the exception. The industry reported an underwriting loss that year. Negative cost of float, remember, was a very good thing since it meant Berkshire was getting paid to hold policyholders' money above and beyond any investment income. Still, Berkshire had some variation in its own results. According to Buffett, really extraordinary results were turned in by National Indemnity. The details proved his words were not an exaggeration. Buffett highlighted the portion of National Indemnity's business operated by Phil Leach, which underwrote to a profit of $8.4 million on $82 million of earned premiums, a combined ratio just under 90%. Workers' compensation premiums earned fell by 35%, yet profitability soared. This result, Buffett said, was far, far better than we had any right to expect at the beginning of 1979, and was due in large part to favorable results in California, which finally began pulling its weight after years of struggles. In Berkshire's other areas of insurance, the numbers were not so good. Home State reported disappointing results in 1979. Part of the problem lay with Cornhusker Casualty Company, which had poor underwriting results on top of other issues that required the attention of Jack Ringwalt. Nonetheless, efforts to expand what Buffett viewed as a sound long-term business in Home State Insurance continued with the formation of a Colorado subsidiary. Losses were also reported in reinsurance following the trend of the industry overall. Tempering the loss, but only partially, was the meaningful source of float reinsurance provided to Berkshire. Buffett remained optimistic for the insurance business, even though he expected a tough 5-year period ahead with an industry-wide combined ratio in the area of 105%. Part of the problem, he explained, was interest rates. High interest rates were causing managers of insurance businesses to take on less profitable business, since even a modest cost of float, somewhere above 100%, would be a cheaper source of funds than could be obtained elsewhere. Another source of optimism was high gas prices, which caused people to drive less and therefore lowered auto accident frequencies. Investments. Though Berkshire preferred equities, bonds were an important part of the investment portfolio. At year-end 1979, bonds on the insurance balance sheet, at amortized cost, amounted to $186 million compared to equities, at market, of $337 million. Buffett pointed to accounting conventions as a major contributor to the extraordinary amount of money lost in bonds by insurance companies. Because those conventions reported their value at amortized cost, the fluctuations in market values, due to changes in interest rates, were not realized, either in the accounting sense or in the cerebral sense. Some managers had no idea that bonds could lose so much value. Instead, some insurance companies were blind to the fact that high interest rates caused the real economic value of their bond investments to decrease in value. As the ubiquitous line in financial reporting goes, bond prices move inversely to yield. Buffett speculated that if managers were forced to recognize the value of their bonds at market value and not at amortized cost, managers might have been focused much earlier on the dangers of a very long-term bond contract. A master at analogy, Buffett used an example to illustrate the inconsistency of insurance company managers. Managers were cutting back on issuing one-year policies, reasoning, correctly, that 6-month policies would better protect them from the rising prices of delivering on their insurance promises. Yet those same managers took insurance premiums and sold the money, i.e. invested it, at a fixed price for 30 or 40 years. It was interesting, thought Buffett, that buyers seeking a fixed price contract for any other product or service over the same time would be laughed down, yet the buyer of money could lock in a fixed interest rate for a generation or more. Buffett's criticisms were not only for others. He was, in fact, hardest on himself for the mistakes he made in bonds. You do not adequately protect yourself by being half awake while others are sleeping. It was a mistake to buy 15-year bonds, and yet we did. Instead of staying in a tough situation in bonds, he should have realized his mistake and sold at a loss. It was a lesson, he told readers, he should have learned from the textile business, noting, "We should have realized the futility of trying to be very clever in an area where the tide was running heavily against us." Banking. The Bank Holding Company Act of 1969 set a deadline of December 31, 1980, for Berkshire to divest Illinois National Bank and Trust. Buffett asked shareholders to give Eugene Abegg, its founder and manager, a standing ovation for his achievements, and well-deserved they were. The year 1979 was not only the last under Berkshire Hathaway, but the bank had its best year on record with a return on average assets of 2.3%, 3 times greater than the average major bank. To comply with the law, Berkshire was investigating the possible sale of between 80 and 100% of the stock of the bank. Buffett informed shareholders that the sale would not be based on price alone. He genuinely cared about the post-Berkshire ownership of Illinois National and took as much care with its divestment as he had in its original selection. He warned shareholders that such a high-quality asset would not be easy to replace. You simply can't buy high-quality businesses at the sort of price-earnings multiple likely to prevail on our bank sale. More will be said on Illinois National in the summary of 1980. Financial Reporting Prospects. In a section entitled Financial Reporting, Buffett informed shareholders that Berkshire now traded on the NASDAQ. All shareholders would be able to hear from Dow Jones, the financial news giant, at the same time when Berkshire reported earnings. Buffett told shareholders that while the quarterly reporting would be light, his annual communications would be comprehensive and fitting to an owner of a business. Your chairman has a firm belief that owners are entitled to hear directly from the CEO as to what is going on and how he evaluates the business, just as they would with a private company. Buffett was unconventional in the transparency he showed in his chairman's letter to shareholders. Those shareholders were also unconventional. Buffett pointed out that 98% of the shares outstanding at the end of the year were held by people who were shareholders at the beginning of the year. This loyalty is notable given that stocks are traded daily on the financial markets and frequently have high turnover ratios. Concluding the 1979 chairman's letter under a section entitled Prospects, Buffett tempered expectations for the coming year. He expected higher operating earnings, but predicted the rate of increase to decline. He warned that the dollar figures could come in lower depending on the timing of the sale of Illinois National. Nonetheless, he expressed a long-term optimism about the businesses under Berkshire's umbrella. Berkshire's policy to have centralization of capital allocation and decentralization of operating authority was a formula for success because it was highly scalable. This system would not change in the coming years and would lead to even more success. In 1979, it was still the early days. Chapter 5, 1980 to 1984. Operating earnings of $41.9 million were sufficiently above the $36 million reported the prior year, but the rate of increase in book value, with securities valued at cost, fell from 18.6% to 17.8%. Berkshire also crossed an important yet arbitrary milestone in 1980. Year-end assets topped $1 billion. For the third year in a row, shareholders were treated to a lesson on accounting. This lesson was how the financial results of Berkshire's ownership interest in companies were reported to Berkshire shareholders. The accounting treatment depended on whether Berkshire owned 100%, between 50% and 100% of the business, between 20% and 50%, or less than 20%. In all cases, the only thing that mattered to Buffett was the proportionate economic performance. Whether Berkshire owned 100% of a business or one share didn't matter. The accounting was another matter, and Buffett wanted Berkshire shareholders to understand how it could skew the financial picture. 100% ownership. This is a wholly owned subsidiary and the most straightforward case. Financial results are fully consolidated with the parent company. Its balance sheet items, cash, receivables, inventory, fixed assets, liabilities, etc., and income statement items, revenues, expenses, etc., are reported together with the parent company's financials. Such accounting treatment makes sense since the new or subsidiary business becomes a part of the parent, even if its results are detailed separately. This was the case for Berkshire's original textile operation in New Bedford, Massachusetts, and its Wambeck operation in Manchester, New Hampshire. One problem with such accounting arises when a parent company owns many diverse businesses. Remember back to the 1978 discussion of the Berkshire Diversified Retailing merger. The merger caused the fully consolidated results to become nonsensical or at best of little value, since the accounting obscured reality. Berkshire therefore began providing a separate table to shareholders to help them make sense of the noise. 50 to 99% ownership. When a business owns between 50% and 100% of another business, the minority shareholders, those owning 49% or less, must be considered. In these instances, a 1A item can be added to the fully consolidated method of accounting. The solution is to keep the accounts consolidated like the example above, along with the accounts of the majority owner, but to add an entry on the financial statements for minority interests. The financial accounts are lumped together with the parent, and both the equity and the equity in earnings attributable to the other shareholders is accounted for with a single line item. 20% to 49% ownership. With this level of ownership, the accounting treatment is like the minority interest accounting above, only the parent company in question is the minority owner. To use a Berkshire-specific example, Blue Chip Stamps was accounted for in this way until Berkshire's investment crossed the 50% threshold with the diversified retailing merger. Prior to that time, the only entry attributable to Blue Chip was an equity in Blue Chip Stamps, representing Berkshire's proportional ownership in Blue Chip, and a similar entry on the income statement, accounting for its share of earnings named Equity in Earnings of Blue Chip Stamps. Less than 20% ownership. This is where economics and accounting diverge. Accounting rules dictate that only the dividends received from an investee in this class can be counted as income. To use an oversimplified example, if Berkshire owned 19.99% of a company with $100 in net after-tax earnings, paying out no dividends, it would record no earnings from this investment. If instead it owned 20% of the same company, it would record an entry for equity in earnings of XYZ of $20. It's the same economics, just drastically different accounting. Berkshire's insurance companies own significant amounts of stock, many of which fell into the last category, and since many of these investees retained most of their earnings, in other words, paid out little of their earnings as dividends, the income did not appear in Berkshire's financial statements. In fact, Berkshire's share of the income of these investees, called look-through earnings, were larger than the total reported operating earnings of Berkshire. To paint the mental picture, Buffett described a large iceberg mostly hidden below the surface of the water. The substance was there, one just needed to look more closely to see it. Buffett warned shareholders that his views were unconventional. He needed them to understand that he focused on the economics, not the accounting. Buffett showed he could immediately increase Berkshire's reported results, even though such an action tempts us not at all. All he would have to do is sell Berkshire's equity portfolio and use the proceeds to buy long-term, tax-free bonds. Such a move would increase accounting earnings by over $30 million, representing over 50% additional after-tax reported earnings. But it would also be detrimental to Berkshire's economic position, since its claim on the underlying earnings of companies in the equity portfolio were worth more. As a controlling shareholder in Berkshire, Buffett could follow the path that made the most sense in pure economic terms, rather than be tempted by the apparent prosperity allowed by accounting. As it turned out, inflation peaked at 13.5% in 1980. Buffett likened inflation to an implicit tax on capital. When combined with the explicit income tax, an owner of a business, even a very good business, could lose purchasing power. The example Buffett used was a business earning 20% return on equity in a world of 12% inflation. Someone in the 50% tax bracket would, if he or she was paid out all earnings as dividends, end up with a 10% after-tax return and lose 2 percentage points of purchasing power a year. Since Berkshire was not immune to inflation, Buffett wanted shareholders to be aware of its pernicious effects, even if it had no solution to the problem. Sources of earnings. Berkshire's pre-tax operating earnings increased 16% to $54 million. See Table 4.2. The primary driver was improved results from insurance, presented in more detail below, followed by increases at Seas and Blue Chip Stamps. To provide Berkshire shareholders with as much relevant information on their investment as possible, for several years Buffett had included the letters to shareholders from its major investees, Blue Chip Stamps and Wesco, at the